Hello my dear future charters. Welcome to paper discussion series by More Academy. I am Professor Anand More, your guide for CA course. If you have completed earlier videos, then congratulations. You are near to completion of 60 marks question paper. In the previous video, we have discussed the question of ADD, average due date. Now we will be considering question number 3C. Let us go ahead to the question. You can see here that question C has two sub-questions, but you are not expected to solve both. This is a question with internal options. So you need to decide the question that you are comfortable with. Both carry 5 marks. I'll be discussing both questions one by one in this video, but you need not solve both the questions. You will be solving any one of them, whichever you find it convenient. Let me now focus on the first option, that is the question of account current. 3C1. From the following details, prepare an account current as sent by A to B on 30th June 2021 by means of product method charging interest at the rate of 6% per annum. So 2021 January 1st balance due from B rupees 600. January 11th sold due from B 520, that means goods must be sold to B. January 18th B returned goods rupees 125. February 11th B paid by check rupees 400. February 14, B accepted a bill drawn by A for 1 month, rupees 300. April 29th, goods sold to B, rupees 615. May 15th, received cash from B, rupees 700. So the problem is asking us to prepare the account current. Let us make some basic observations which will help us for the purpose of solving the question. The account current is prepared by Mr. A, who is a creditor, to be sent to Mr. B, who is a debtor. We are not expected to use the interest method, but we are expected to use product method. So simple interest method is not expected, but product method is expected. In the simple interest method or the interest method, we calculate interest for each transaction for the period from the date of transaction to the date of account current. And in the product method, we calculate the product of each transaction by multiplying the amount and the number of days from the transaction to the date of account current. Then we find out the balance of product. Lastly, we calculate the interest on this balance of product for only 1 day. We are supposed to follow product method. That means I'll be ignoring point number 3 when we are thinking of solution. I'll be considering point number 4. For that purpose, it is necessary for us to check the delay or the duration between the date of transaction and the date of account current. So dates of transaction are 1st January, 11th January, 18th January, 11th February, 14th February, 29th April and 15th May. And the account current is prepared on 30th June 2021. It means we are required to consider the duration or delay from each transaction up to 30th June. So 1st January, 11th January, 18th January and 11th February, there is no problem. But when I'm looking at February 14th, the transaction there tells us that B has accepted a bill drawn by A for 1 month. If that is the case, the transaction is not required to be considered as happening on 14th of Feb. The transaction for the purpose of account current can be considered to be completed after considering the period of bill. The period of bill is 1 month, and for every bill of exchange there is a 3 days grace period which is supposed to be given. So 14th of February plus 1 month and 3 days, that comes to 17th of March. So these are the different dates which we are required to consider when we are calculating the duration or the delay from the transaction date up to the date of account current. So for 1st January, it will be from 1st Jan up to 30th June. That means all 31 days of January, 28 days of February, because it's not a leap year, it is 2021. That means only 28 days. Then March 31 days, April 30, May 31, June 30. So total number of days from the first date up to the date of account current are 181. For 11 January, January will be considered only for 20 days now. 31 days of January minus 11 days already deducted. That comes to 20 days of January. February, March, April, May, June, all days will be as they are. Therefore, the total will be 170 days. For 18th of January, it will be 13 days of January. Then rest of the months, all full days. That comes to 163 days. For 11th of February, January will not be counted because the transaction didn't happen in the month of January. Transaction happened in the month of February, not on 1st February, but on 11th February. So 28 days of February minus 11 days, that comes to 17 days of February. And then 31 days of March, 30 days of April, 31 days of May, 30 days of June, total is 139 days. For the next transaction, we have already discussed 14th of February is not important for us. The transaction is going to be completed on 17th of March. So the amount is actually received on 17th of March. So the delay will be considered from 17th of March up to 30th June. Accordingly, we can specify that January, February need not be counted. March month is having 31 days, out of which 17 days are supposed to be deducted. That means 14 days of March and rest of the months full days. Total comes to 105 days. For 29th of April, nothing of Jan, nothing of Feb, nothing of March. April 1 day because 30 minus 29, and then May and June full month. For 15th of May, January, February, March, April, no days required to be considered. And directly we'll consider May 31 minus 15 is equal to 16 days and June 30 days. Total comes to 46 days. So these are the different days which we are required to consider when we are thinking of preparing account current. Once this information is available, we can start with our calculation of or our preparation of account current. An account current is basically your normal ledger account with some additional columns to facilitate calculation of interest. So as usual, your ledger account is going to have two different sides, left hand side and right hand side, date, particulars, amount. These are the usual columns of your ledger account. But additional two columns are prepared on the debit side, that is the days and products. Then again on the credit side, you are having date, particulars, amount, which are the usual columns of ledger account. Additional two columns for calculation of days and products. Now we'll consider the transactions as given by the problem. 1st January opening balance 600. 11th January 2 sales 520. 29th April 2 sales 615. These are the basic things which are given by the problem. Then on 18th of January buy sales returns 125 rupees. 11th February buy bank 400. 14th February bills receivable which is falling due on 17th of March 300. 15th May buy cash or bank 700. So these are the transactions which we have prepared now out of the transactions which are given in the problem. Now let us write down the days which are applicable for each of these transactions. 1st Jan number of days are 181, that we are writing it here. 11th Jan number of days are 170, so that is what we are writing here. For 29th April, 29th April is here, number of days are 62, so 62 days are written here. 18th January number of days are 163, 18th January 163 are written here. Then February 11th the number of days are 139, so 139 are written here. And February 14th, which is falling due on March 17th, number of days are 105, so those 105 are written here. And last one is May 15th. May 15th number of days are 46, so those 46 are written here. Once we have completed the amount and we have completed writing the corresponding days in relation to each of the transaction, then we can find out the product. Product is equal to amount into days is equal to product. Amount into days is equal to product. For each of the transactions, we'll write down the product now. Thereafter, we'll find out the balance of product. So the total of product on the debit side is 2,35,130, and total of product therefore is written here on the credit side also. So the balance of product is 95,455, which is the balancing figure. On this balance of product, we are going to calculate the interest. As I had already mentioned, it will be calculated only for one day. So it is nothing but 95,455 into 6%, that is 6 upon 100, into 1 upon 365. So it is divided by 365. That comes to 15 rupees 69 paise is the amount of extra interest we are going to charge, because debit side product is heavy. That means the person is our debtor. So we are going to demand an interest of 15 rupees 69 paise from Mr. B. So the heading will be B in account current with A. Interest up to 30th June 2021 at the rate of 6% per annum. If you forget to write the heading, then 1 mark will be lost by you. And then calculation. Don't forget to show the working for the purpose of calculation. Once you do that, then 5 marks are ready. If on the other hand, you find account current to be a little weak topic for you, you are confused about product method, one day interest or multiple days interest, how to calculate balance, where the balance of product should be written, where the interest should be written, then you may skip this question and you can go for the second question of question number 3C. The second question is a partnership. In the next part, I'm going to consider the question of partnership. So let us consider next question. Now question number 3C, part 2. This is an optional question. If you have not solved account current, then you should solve this. If you are comfortable with account current and you have solved it, then this part you need not consider. Question number 3, C, sub question 2. A, B and C are partners in a firm. On 1st of April 2019, their fixed capital stood at rupees 50,000, 25,000 and 25,000 respectively. As per the provisions of partnership deed, C was entitled for a salary of rupees 5,000 per annum. All the partners were entitled to interest on capital at the rate of 5% per annum. Profits and losses were to be shared in the ratio of capital of the partners. Net profit for the year ended 31st March 2020 was rupees 33,000 and on 31st of March 2021 was rupees 45,000. It was divided equally without providing for above adjustments. So adjustment number 1 and 2 were not followed when the distribution of profit was done in the year of 1920 and in the year of 2021. You are required to pass an adjustment journal entry to rectify the above errors. So what are the different errors? Two different transactions were not recorded for 2 different years, and instead of dividing the profit in their capital ratio, the profit is divided equally. Sir, how did you understand equally? Because it is mentioned in the problem in the last part that the profit was divided equally without providing for the above adjustments, and it should have been divided in the ratio of capital. So let us consider the observations. The first observation is that there are 3 partners and the firm is following fixed capital method. It means the adjustment of salary, interest on capital, drawings, interest on drawings, all of them should be made in the current account, not in the capital account. So when we are going to pass the journal entry, it will be in the current account. The PSR is in the ratio of fixed capital, that is 50:25:25, 50:25:25, or you can say 2:1:1. Last year net profit of rupees 33,000 and current year net profit of rupees 45,000. Both are already distributed in 1:1:1 ratio, which is a mistake. And the adjustments pending in both these years are C's salary of rupees 5,000 per annum. Now it is for 2 years. That means the salary will be rupees 10,000 for both the years. And interest on capital at the rate of 5% per annum, which will amount to rupees 2,500. 50,000 into 5% is equal to 2,500. 25,000 into 5% is equal to 1,250, and again 25,000 into 5% is equal to 1,250 for A, B and C respectively for each year. Now since there are 2 years, that means the profit will be rupees 5,000 per annum, 2,500 plus 1,250 plus 1,250, that is 5,000 per annum, or we can say 10,000 for 2 years for both the years taken together. That means C's salary for 2 years 10,000, adjustment is pending, and interest on capital rupees 10,000 for all the partners taken together for 2 years, adjustment is pending. With these basic adjustments or with this understanding, these observations, let us now consider the entries to be passed. So let us prepare a table first. What must have happened, what should have happened, and what is supposed to happen. So what is to be done now? So amount which is already credited is the profit for both the years. Profit for both the years is equal to how much? Rupees 45,000 and 33,000. 45 plus 33 is equal to 78,000. It was already divided in equal ratio. That means it was in the ratio of 1:1:1. So it was divided as 26,000, 26,000 and 26,000 to A, B and C. It is already being done. This has already happened. What should have happened? Out of this 78,000, 10,000 rupees should have gone to Mr. C as his salary. So only Mr. C should have got 10,000 rupees. Out of 78,000, again 10,000 should have gone to A, B and C. Mr. A should have got 2,500 for 1 year. That means 5,000 for both the years. Mr. B should have got 1,250 for 1 year. That means 2,500 for both the years. And same is the case with C. 1,250 for 1 year. That means 2,500 for both the years. That means out of 78,000, 10,000 should have gone to A, B and C as 5,000, 2,500 and 2,500 under the name of interest on capital. So out of 78,000, 10,000 to only C, and out of 78,000 again 10,000 to A, B and C like this. So what is remaining is 58,000. This 58,000 should have gone to them in their fixed capital ratio, and the fixed capital ratio is 2:1:1, that is 50:25:25. Accordingly, we are dividing 58,000 as 29,000, 14,500 and 14,500. So how much A should have got? 0 plus 5,000 plus 29,000. That means A should have got 34,000. Mr. B should have got 0 plus 2,500 plus 14,500. That means he should have got 17,000. And Mr. C should have got 10,000 plus 2,500 plus 14,500. That means he should have got 27,000. So A should have got 34, B should have got 17, C should have got 27, but they already received 26 each, 26,000 each. So A should be getting 8,000 rupees more. C should be getting 1,000 rupees more. He has got 26, he should have got 27, he will get 1,000 rupees extra. Whereas B should have got only 17, whereas he has got 26,000. That means he has got extra amount of profit in the past. Now he will have to give back that profit. That means he will be giver, and A and C will be getting that particular profit from B. B will bring in 9,000 rupees. Now the adjustment, since it's a fixed capital method, cannot be made in capital account. It should be made in current account. So B's capital account will be debited by rupees 9,000. B's current account will be debited by rupees 9,000, and A and C's current account will be credited by rupees 8,000 and 1,000 respectively. So the necessary adjustment journal entry is only one entry. B's current account debit rupees 9,000, to A's current account 8,000, to C's current account 1,000, and then write the narration: salary to C, interest on capital charge, and profit shared among the partners in the ratio of capital. So this is a simple question as compared to account current. If you are aware of the basic treatment about fixed capital, current account, PSR, treatment of salary, treatment of interest on capital, etc. Depending upon your choice, you can decide which question to be solved in examination. So here you complete 60 marks of your accounts paper of December 2021. In the next video, I'm going to talk about question number 4. So see you in the next video.